Hello and welcome to a brand new episode of ET Markets PMS Talk, a show where we discuss the opportunities as well as investment strategies deployed by the fund manager in the popular space of ultra HNI investing. Well, my name is Shatajananda, and today we have with us a very special guest who's Naysar Shah, who's a managing partner equities at Credent Asset Management, who's managing AUM of around about 122 crores. Welcome to the show, Mr. Shah. Well, Mr. Shah, let me quickly come to the strategy. The multi-cap strategy, in fact, it has given impressive returns since inception, approximately doubled when compared to the benchmark index. Now, if someone would have invested, let's say, 50 lakh at the start of the fund, how much money would have the person made?
Yeah, actually, so we just started the strategy in third week of March, and though it's a very just we're just looking at maybe let's say 3 month and 3.5 months time period.
Right.
Somebody would have invested at the inception 50 lakh, maybe as of yesterday and as of 12th July, that would have become roughly about 64 lakhs.
Right. In fact, we are seeing quite a bit of action in the markets as well. What is your take on the market amid the global interest rate headwinds that we're seeing?
Yeah, so if you look at on the interest rate side, so let's come to inflation first. So yesterday, US inflation, the print came in at 3%, which was at which was at low since March 21.
Hmm.
Versus that, we have even seen an interest inflation of 9% sometime in CY 22,
Right.
which was at 40-year high. So from a 40-year high of 9%, yesterday we saw 3%, which was at 18-month kind of low, right? So it seems that, US interest rate has peaked out. Inflation numbers are, better.
Hmm.
And in India also, it seems that interest rates have peaked out. We could be in an extended period of pause or something like that, but it seems that interest rate has peaked out. So interest rates, which was a worry for last 18 months or so, for the most of the CY 22 and early part of CY 23, that seems to be no longer a
Hmm.
headwind, and hence so that's no longer a headwind. So now you track earning growth, how we are trading it in terms of valuation vis-a-vis the earning growth that Indian companies or Nifty were to offer. So if you look at on the earnings front, FY23 we saw Nifty earning growth of about 11% on the back of 32% growth in FY22.
Okay.
And this year as well, we expect earning growth to be about 13 to 15% for the year as a whole. So on a FY24 basis, Nifty is roughly trading at about 20 times, which is slightly above long-term average, but it's not, a very euphoric zone or significantly overvalued. So we are okay in terms of valuation. So we broadly now, track earnings growth, and then of course you have individual companies which could grow earnings faster than Nifty, and
Yeah.
have superior earning growth profile. So it'll be broadly bottom-up stock specific approach that I think market would reward that approach in our view.
Right. In fact, Mr. Shah, can you also take us through your investing style and how do you manage risk in the fund?
On the investing, we use a combination of top-down and bottom-up approach. Top-down approach just to see, which are the industries which are favorably placed, where you see headwinds and
Hmm.
tailwinds in the near to medium terms, right? So that's how you assess the industry characteristics in terms of growth profile, the profit pool, and then you have individual companies within sectors which are going ahead of the sectors, and
Right.
and then have a superior earnings growth profile, higher capital efficiency along with good management, right? So you study various companies within that sector, and then based on finally look at the valuation, and where you have comfort on valuation, looking at risk reward, and
Hmm.
then you pick individual stocks in the portfolio across industry sectors, and and construct a diversified portfolio. So that's broadly the approach that we follow. And on the risk front, we keep a diversified portfolio across large cap, mid cap, and small cap across. So it's a multi cap portfolio, right? And we do not take very high exposure to smaller names. By smaller names, I mean smaller
Hmm.
names in terms of market cap, right? So we tend to have slightly more, few more, rather few names in small cap, micro cap space, just to diversify this, so not to so just to avoid the concentration part of illiquidity part of the risk, right? So we keep a diversified portfolio, and since it's a multi-cap, the risk is not that high compared to versus or a volatile versus let's say a very purely a small cap or a micro cap kind of portfolio. So it's a very diversified portfolio, and we manage allocations based on liquidity and the
Hmm.
size of the company. So and we look at margin of safety in terms of valuation. So diversified portfolio takes care of the risk aspect to a large extent.
Right. In fact, you mentioned multi-cap. Wanted to understand from you, the small and the mid-cap space does look interesting at this point in time. In fact, in touch fresh record highs recently. So, what is your take on the space for the next, let's say, 6 to 12 months?
I mean, next 6 to 12 months will be very difficult to call out, but medium to long term,
Yeah.
this space will do well. If you look at,
Okay.
see, while there is euphoria in the market, you can say in small cap, but if you look at the March, March was very bad for small cap, micro cap names, right? So
Yes.
we have seen good move from the March lows, but as of June, and let's say even if you have to look at last 5 years,
Mm.
Nifty had done about 12.54% CAGR last 5 years.
Mm.
Mid cap index was about 15.4 and small cap was about 8.69% kind of. So 5 year ended June, small cap index had still underperformed mid cap and large cap. While we are looking at near term, it's done well and all that, but on a 5 year basis, they had still underperformed the other two indices, right?
Right.
And and if you look at, well, we call it a small cap, but of course you have to look at the individual companies
Mm.
within that, right? So you could still have, companies which are doing well, differentiated product profile, earnings growth, balance sheet, and all that. So ideally, one should look at the business model, promoter pedigree, valuation, and all that, and then
Mm.
decide rather than just put it under a, just a small cap kind of bucket and say whether this company or this stock will do well or not. So you have to assess it
Mm.
on a bottom up on the merit of each company and then see whether it makes sense for you to own it or not. But yeah, of course, as I said, from March lows, small cap index had done well. But if
Mm.
one has to see, there could be correction anytime. I mean, it's very difficult call where the market small cap can
No, no,
correct 8,
absolutely
10%
right.
other. But if
Yeah.
you look at medium to long term, since they're coming on a very low, on a low base, earning growth could be significantly higher compared
Okay.
to other categories. And if earning growth, management, and all those factors are in place, and then as a space, they could do well over medium to long term.
All right. Also, Mr. Tell us how do you pick stocks for the portfolio and tell us about your viable investment approach.
So, Sushil, as I said, we follow a combination of top-down and bottom-up approach,
Yes.
and we keep a diversified portfolio. So, when I say
Mm.
viable, not in that order, but let's say in the industry, so innovating industry or where the industry has to make sense for us in terms of investing, should have a, very low terminal risk and have products and services which are acceptable to other people. So innovation, or maybe you could say new products or the new categories, companies could be expanding into newer segments,
Okay.
and authority in terms of governance. Obviously, you have to
Mm.
look at the promoter or the promoter pedigree about the companies who are driving the business. Okay, business matrices in terms of growth profile, capital efficiencies,
Mm.
and all that, and low meaning low leverage, earnings consistency or the earnings growth, and V stands for valuation. So
Okay.
if all of these make sense, of course, one then still has to look at valuation, whether you are overpaying too much for the growth
Mm.
that you expect company to deliver, or it's not being priced in, or it's not being well understood by the market. So that is broadly the philosophy that we follow while constructing the portfolio.
Absolutely. And I was just going through the fact sheet as well, Mr. Chow. So, what makes you so optimistic about financials, consumer durables, as well as auto actually sectors?
So if you look at financials, we expect credit growth to remain very strong. The
Mm.
latest print suggests about 15% YOY credit growth, and driven mainly by SME and retail segments. So we expect credit growth to remain strong. And if you look at the asset quality, gross NPAs and net NPAs are at multi-year low.
Mm.
Credit quality, asset quality is very good. So credit cost will be under check. So, while NIMs can moderate from elevated levels of FY23, but we still expect pre-provisioning profit growth will still be very strong, and that along with muted credit cost or the low, credit loan loss provisioning, okay, that would still means banking sector would still show very healthy earnings growth. And if you
Mm.
look at the valuations on the private side, they are still broadly in line with the long-term averages. Sector has done well, but valuations are still in line with long-term averages. So we expect banking sector to do well. Coming to consumer discretionary side, uh, India is just about, let's say, $2,300 GDP per capita. And when you look at, let's say, other other countries, and on maybe look at, say, China, when they move
Mm.
from $2,000 per capita to $5,000, various discretionary consumption categories has they had grown anywhere between 17 to 25% for a considerable period of time. So we are
Right.
just at the threshold of that. So we feel consumer discretionary categories, will show a very good growth in the medium term. and hence, we are bullish on that segment.
Right. Any recent
Coming to
entry or
auto,
exit? Huh.
sorry, on the auto component side, India is one of the top five auto markets, in the world. And after COVID, we have seen good recovery. So two-wheeler domestic has started doing well. Passenger vehicle had a very good FY22 and FY23. So passenger vehicles would slightly show muted growth compared to 23, but two-wheeler is recovery. And tractors will show muted growth, and CV will also show muted growth. But
Hmm.
no, you still have a lot of potential when it comes to auto OEMs. And of course, when the auto segment does well, and then your auto component sector does well, then you have
Hmm.
replacement market opportunity as well as export opportunity. So China plus one, China is a very large exporter of auto component,
Yes.
products. So we feel that even in India, with China plus one thesis playing out, Indian auto component industry has significant export opportunity, and we expect that segment to do well, particularly.
Okay, cool. Also wanted to understand any recent entry or exit that you've made in the fund recently?
So we just started this portfolio in March,
Hmm.
but just in terms of a few entries, so we have added CDSL, which is a capital market play, demand penetration and participation by individuals. All that remains very. So we see a structural long opportunity. Cash market volumes, if you see last few months, they've revived from FY23 lows, right? And stock, it's a duopoly, and it trades roughly about 33 times by 24. So we are bullish on that, and it's being our latest,
Ah.
addition to the portfolio. The other one being Electronics Mart India Limited.
Hmm.
It's the largest consumer durable retailer in EP and Telangana, and now is expanding into North, adding a few stores in NCR and all that. And consumer durable retail again is a very large opportunity considering the penetration levels of across all categories.
Okay.
And he's a very efficient retail player, and it roughly trades at about 27, 28 times F24. So we are bullish on that name. So these are the broadly two additions that we have made recently.
Right. Well, on that note, thank you so much for your time, Mr. Shah. And that's all for now. But do stay log on to etmarkets.com for more on news, business, and economy. Thank you so much for your time.